The management is now joining us. Abed Ali, CEO and member of board at Wipro, as well as Jatin Dalal, CFO at Wipro, are now joining us. Abed, let me first start with you. Can you just describe the quarter in terms of what was the organic growth, what was the growth led by acquisition, just break down which sectors did well?
So Pankaj, as you are aware, we don't give the breakup of organic and inorganic, but I would like you to see it in the light of we gave a 2 to 4% guidance, and we've delivered 2.7% constant currency growth, which we feel quite good about. And I think a lot of parts of the organization kicked very well. Our consumer business did well. Our healthcare and life sciences business has done quite well. Our product engineering services, our GIS business, we've had a good deal flow in market terms. The US market has done well. The India geography has done quite well. So overall, there are sectors which have fired quite well, and in some sectors we've had some softness, which you are aware of. Especially the ENU segment continues to be soft due to the uncertainty in the oil price. We have seen some additional softness in the banking sector in Europe. So that is kind of an overall color on the Q4 growth and our Q1 guidance.
Jatin, performance of BFSI and energy continues to hurt the company?
Our overall hypothesis is that there is a little bit of softness as we enter quarter one, and that's how we have factored it in our guidance for quarter one. But we do hope that some stability and therefore flow through of business should start coming in the later parts of the year.
Right. Abed, what will be the guidance in Q1? Are you looking at a strong start?
So we've guided, between 1 to 3%, and we have seen a good deal traction in Q4 and Q3. As you had seen, in some of those transitions are undergoing, and some of those will start contributing to our growth. I think there is also an element of 2 months of the HPS acquisition that we did, which will be part of this. So overall, I think we see from a client perspective, there is a flat IT spending. There is no significant increase in technology spending. But what we are seeing is movement of the spend from the run side of the business to the change side of business. So while there is pressure on the run side in terms of delivering higher productivity, which we are doing very well with hyper automation and as a service business model, there is a lot of cash becoming available with customers to be able to do digital transformation, where we are seeing quite a lot of traction as well.
Abed, we recently spoke to TCS as well as Infosys after their numbers. They are your clear-cut peers. I just wanted to understand that they were very positive going into FY17, saying that the exit rate may not be that good. Industry growth rate in FY16 was not particularly that great, but still headwind seems to be lower than at the start of FY16. Would you agree with that thought?
Broadly, we are seeing good deal traction. As I said, in Q4, we have had one of our highest order books. So we do see, I see opportunities across clients. I've met about 70 of our top 100 clients in the last 80 days, and there are certainly opportunities. There are certain things that we are doing internally to be able to make best of those opportunities. So I'm quite optimistic and excited about FY17.
Jatin, in the previous 3-4 quarters, what we have seen is that verticals are getting very, very cyclical to predict. Is it getting difficult to predict various verticals, and what will be the growth over there? Yes,
and I think it's been reflected because of two fundamental changes. I think there is a vertical play there where I think commodity prices have undergone huge changes. And then there are interest rate outlook which impact variety of industries which continue to change and have continued to change over last 24 months. So there is that vertical volatility. We have also seen a technological shorter and shorter cycle of deployment, high, huge demand, and then something else becomes the new fashion or new requirement or the new demand driver. So I think both volatilities are playing up on our business model, but at the same time we are investing heavily in terms of cross training, continually making people market ready for next potential opportunities. So we are, I would say, preparing actively for that complexity, and that complexity is here to stay. And I think the winner would emerge from the best prepared organizations, and we are gunning ourselves to become one of that.
Right. We've done a couple of acquisitions as well. You think it'll take 2-3 quarters before the acquisitions settle down in the company or start to gain benefit?
So, Pankaj, you'll be surprised. I think we are past the phase where we could wait for 2 or 3 quarters to really see the benefits of an acquisition, because we are really running, a running organization which is running at its capacity. So what we do is, even before we sort of seal the deal and pay the company and acquire it, we have a very detailed first 10 days, 30 days, 60 days plan. And on top of that plan is the joint go-to-market access and how we start leveraging each other's strength. So I would think that we are already participating, benefiting in our early success in the 2 acquisitions that we have completed last quarter. And so far that looks quite exciting.
Abed, I was looking at the large account matrix and it deteriorated further by 13%. Is that a cause of worry?
Definitely, we are investing very heavily in account mining, and some of the large account are client-specific issues. Some of them, as you are aware, we had a large proportion of our top accounts in the oil and gas sector. So that did see a lot of headwinds last year. But I think, there is a lot of opportunity in all of our large accounts. We have a very strong set of customer list. We have strong set of capability. We have a strategy which is very relevant in areas where our customers are spending in. We are undergoing a sales force transformation and delivery force transformation, investing in our leadership team. About 2,000 salespeople are undergoing a program called One Voice, which helps them do consultative selling to customers in the area of digital and innovation and domain-led services and integrated services. We are investing in our delivery leadership in a program called Adroit, which about 1,000 delivery leaders are going to get covered in that, where it helps them do delivery-led sales, which helps with top account mining. So some of those things are enablers for us to be able to deliver better growth in our top accounts. So no, I'm not concerned about it. I'm in fact very optimistic about it.
Right. These are the efforts that you've taken, but it'll take some time before we see these efforts playing out, at least, 2-3 quarters.
Absolutely. Some of these things take time. Some of the 6 themes that I've identified, some of these themes deliver results earlier, some of these themes deliver results later. But what I would say is we need to look at it on a periodic basis in terms of change of trajectory on a quarter by quarter basis.
Jatin, as far as margins are concerned, they were flat, but last quarter we had the Chennai floods impact coming in. So people were expecting, some sort of improvement over there. In that case, it's a disappointment?
No, in fact, we had a good quarter because we had an investment of acquisition-related margin impact in quarter 4, which was roughly 0.5%, and we fully recovered that, and we stayed flattish on a flat currency quarter from margin standpoint. So I would think that the operational improvement actually helped us recover the investment. We also had a little bit of a challenge in our India and Middle East business, which is working its way through in some of the large contracts. But we are quite hopeful that some of these investments over a course of next few quarters will start paying back, and that also we mitigated and we remained flattish on quarter 4. So on the whole, a decent, reasonable, good quarter from a margin standpoint so far as Q4 was concerned.
Jatin, off late, the quarterly volatility in margins seems to have increased. Do you think for IT sector as a whole, one should start to look at yearly margins?
Yearly basis is definitely a better way of looking at it, Pankaj, because we will have to invest on one thing and the other as on a quarterly basis. If I talk about Q1, we will invest a portion of our margin in Q1 on employees, and we do want to. We have talked about a 30% higher budget this year for merit salary increases, as well as we will invest on the margin impact of 2 months consolidation of health plan services. We consolidated 1 month in Q4, and we'll have 2 months incremental impact in Q1, and that those investments will play out, and we will be able to recover some of them during the course of the year as volumes start picking up during the course of the year. So yes, year on year would be a good indicator for all of us to keep a reference on. Having said that, we don't guide on margins, so I would refrain from sort of making last year or any earlier years as a base for 16-17. But from a volatility standpoint, your question is valid, and I think full year is a better way of looking at margins.
Abed, you spoke about 5-6 initiative earlier that you have taken. It focuses on the top line. Will it also focus on margins?
Absolutely. Number one is it helps with growth, and growth helps with margins. Number two, there are some very specific themes over there which I have laid out of the 6 themes, which directly impacts employee productivity and margins.
Right. Abed, a lot of large cap companies have indicated that there is intensifying competition or competitive pressure. Do you think that that's happening, or that was always the case?
I think the competition has always been there, and as new services come and as the disruption is happening in the industry, obviously we also see new players coming on. I think we are very differentiated in what we have to offer, especially technology and engineering has been Wipro's strength historically, and as digital happens, a large amount of technology and engineering is required to be done. Design is an area which is a general weakness across the board, but we are very fortunate to have acquired ahead of time Designit, which is one of the large global design houses. So I think we have the capability, I think we have the customer relationships. So while competition will always be there, but if you have differentiation, I think you can win in the market, and that is what I feel.
Jatin, the sense that you get from clients in terms of spending, will it be better?
Well, I do believe that there is a good traction in the marketplace. There are certain pockets which are soft as we enter the year, but as they solidify, in the course of the year, we should see some good uptake during the course of the year. So I am quite hopeful as I see the traction in the marketplace.
Right. Abed, just a last word on the digital pack. Now that you've done acquisition, you think next 2-3 years, Wipro will be strongly impacted by growth in the digital space?
Absolutely. Digital is one of our key growth drivers, and whenever and wherever we find a good asset, we will not be shy of acquiring if it gives us a unique capability. As I said, acquisition is always for getting unique capability or market access, not necessarily buying revenue.
Right. Gentlemen, thank you so much for taking out time for us.